Good morning, everyone. A very warm welcome to everyone from Nishith Desai Associates uh, and also to our interactive session on the Union Budget 2023, especially for the international business community. Today's webinar, we will be discussing some of the key changes which have been brought about or proposed by the Honorable Finance Minister for 2023. As part of this session, we have our host of experts, in front of you. We have Gauri Gokhale, who heads our IP and TMT practice. We have myself, I head the international tax practice. We have Ashish Sudhani, who is a senior leader in our international tax practice. Afan also, who's a leader in our tax practice. And we have Radhika, who leads our operation from GIFT City. So we have an entire host of experts in front of you to dissect the budget and bring forth and talk about some of the key changes which have been brought about. We will also be joined by our founder, Mr. Nishith Desai, but without further delay, let's just start this discussion. So this has interestingly been the fifth consecutive union budget presentation by our Honorable Finance Minister Nirmala Sitharaman. Notably, this is also her last full-fledged budget because of the elections that are going to be held in 2024. Very proudly so, in our 75th year of independence, the budget recognizes Indian economy as a bright star. Our economy has increased in size to be the fifth largest in the world in the past 9 years. Our growth is estimated as 7%, and this is despite the slowdown caused by COVID, as well as, at the backdrop of a war. Nonetheless, our economy seems to be on the right track. The government seems to be, quite poised to take this to the next, to take the economic challenge to the next level. And in fact, it's also, in times of these challenges, the G20 presidency has also been looked at as a unique opportunity to strengthen our role in the world economic order. And I think, maybe Nishith bhai, you want to say a few words before we really, deep dive into the, the priorities that this budget has laid out and how they intermingle with the tax changes. But probably, a few words from here would be great for our audience.
No, thank you very much, Parul. Good morning, everyone. I think this is the annual event that Finance Minister presents to the whole world about Indian budget and our thoughts forward, going forward. So wonderful to have you all and appreciate coming up in large numbers. So, okay. I think I'll just make one or two comments. A lot of people coming on to talk here and share their experiences and understanding of the budget. So first thing is that, this time the budget, good, it's not touched too many things. It's one way of looking at this is not to interfere too much with the existing framework of law. That's a good news. Second news is, of course, tax rates have been rationalized. Third news is that the GIFT City is getting boosted. Fourth news is that, some tempering has been done with the real estate ownership and housing capital gains. So there are several things that are interesting, but I believe that now time has come to look at the tax laws in a slightly different fashion than what we used to do 10, 15, 20 years ago. And now anything that you do, just assume for a moment that that will be on the front page of the newspaper. So I think the earlier ways in which we used to plan our tax affairs is no longer, you just cannot pick up very strict language and go on to that basis. Two consequences. One, a GAR will have to be kept in mind. Effective interpretations will have to be kept in mind. And, it's no longer that exchange of information will remain under the carpet, I think. So the emphasis has moved from higher rate of tax. At one point of time, we talked about tax competition, harmful tax competition. No longer that per se is a conversation in the world. Conversation is all about exchange of information, KYC, anti-money laundering laws, and stuff like that. So whatever you do, just bear in mind this broader canvas that has emerged. And all countries have reduced by and large taxes. We still have some scope to reduce taxes for individuals, but at the same time, what has been done needs to be appreciated. And um, uh, I think every country, I think, is moved towards that. Emphasis is also moving towards, towards the whole scenario that um, openness, transparency, governance, all these are becoming more and more relevant issues. So I do not want to dwell too much upon these issues, but one or two things hopefully we can bear in mind for the future is a change in the way in which budget is presented. If you see the numbers, the uh, contingent liabilities are never reflected. A lot of hidden liabilities in the budget, for the country is not reflected in the budget. So sometimes you wonder whether the uh, numbers that are coming out are really worth giving a try to, or worth looking at, because just simply because you know for example, tax refunds could be resulting in about 70, 80 billion, $100 billion, or some other hidden liabilities. Those are kind of things that are not often seen because the budget is often representing cash method. So we need to just improve on the way in which the accounts are presented. And there is a lot of scope for now taking position on a global basis where India can take a lead on thought leadership. Uh, all countries are moving, I'll just finish here. All countries are now becoming from, at one point of time, we talked about tax terrorism, but I think we are now talking about tax imperialism as well. A lot of extraterritorial provisions are coming up, not only in India, but other countries as well. I think those are the new issues that we are now looking at. But I would really like to stop here because we have excellent panel of speakers here, and I do not want to take time away from them. But once again, let me welcome everyone. It's exciting. I think things are looking very bright and very good. So by and large, let's move forward. There is nothing like perfect world. And in the imperfect world, I think we have to excel. With those words, I'll just stop here. Thank you so much for your attention.
Thanks a lot, Nishith bhai, for those words of wisdom as usual from you. Now, doing a deep dive into just setting a context of what this budget is really about and where the finance minister is really coming from. Finance minister has actually laid down the vision for Amrit Kal, and this is actually a term which is coming from Vedic astrology, and this shows the emphasis of the government that the coming period in India is going to be the most prosperous period with economic growth and social justice. And the vision for Amrit Kal actually includes technology-driven and a knowledge-based economy, which can be clearly seen, based on the priorities which have been laid down by the government in this budget. So while, on the tax front, not a lot of tinkering around has been done, as Nishith also explained, but the economic agenda for achieving the Amrit Kal vision shows the focus on, on three criteria: opportunities for citizens to fulfill their aspirations, growth and job creation, and strengthening macroeconomic stability. This is being achieved through 7 priorities, and we'll talk about a little bit on how these priorities really drill down from a sectoral perspective. One of the priorities is inclusive development, and as part of the inclusive development, which also includes in specific economically weaker sections of the society and building on the efforts which have already been done. But the other parts of inclusive development also relate to a slew of reforms that are being proposed for agriculture, health education, and skilling, including also actually, the pharma industry. And maybe Gauri, you can talk a little bit about what you are thinking, and how the finance minister is really thinking about the pharma sector based on your number of years of experience in this sector.
Sure, Parul. Thanks for that. I think it was extremely important, especially coming out of pandemic, as to how we are faring, on the overall healthcare and pharma med device side. I think insofar as the initiatives are concerned, which I'll, delve into in a minute, I feel the budget allocation of just 2.1% of GDP is not, sufficient. I think there we could have done a better job. Also, in terms of tax incentives, we don't see any tax incentives. So I think even the industry, if you see the feedback of the industry, they felt that something more could have done. Definitely in terms of GST and direct tax incentives. But overall, if you see from a focus perspective, I think our focus is right there. For example, when you say nursing colleges, right? So it serves two purposes. If the government wants to now open about 157 nursing colleges alongside the hospitals, that will do two things. Of course, meet the demand, the demand out there in the market, especially the what we saw in last 2 years. But it also will help job creation not only within India but outside India. As we know that India is, exporter of nurses, right? So it will also enhance that element. Second, I think on R&D, I look at it more holistically than the way, you read the budget. Apart from what they have done, insofar as, for example, opening the ICMR facilities for both private and public research, excellent initiative, as also proposing to set up centers of excellences for innovation. Now what we have typically seen in pharma industry is we have been pharmacy for the world, but time has come for us to do very innovative basic research, and I think we are sort of uh, poised to go there. But not only that, I think what if we really see other initiatives which they say that teachers training now, skilling the teachers to the next level will also support this innovation, in medical colleges. And the other initiative is focus on AI and use of non-personal data. How does it fit in into the R&D scheme of things? Because if we really see that India has huge amount of non-personal data, healthcare data, right? So that healthcare data can be, can be used along with the AI to develop some innovative solutions, for the country, because we have typically, relied upon foreign solutions in the pharma sector. So I think coupled with all these together, I feel that, R&D is something we can really scale exponentially. And the next one is medical device. So if you see the last financial year, unfortunately, we had 41% growth in imports than the previous financial year when it comes to med device. So I think the focus on the skilling on the med device is equally important, right? So I mean, and all these things, if you see, they are not short term. The reason I said not short term, because as you rightly said, Ms. Sitaraman will be, is this the last budget of this, this sort of term of the government. But all these initiatives are, prepared in from a long-term perspective and not short-term perspective. So you will not see the benefit immediately next year, probably, but these are, 5, 6 years down the line, we will start seeing the benefits. So I believe that we from a focus perspective is excellent. I would expect, probably higher budget, could have expected higher budget allocation and some tax incentives.
Thanks, Gauri. That's quite insightful. In fact, where the AI is concerned, it's really heartening to see how we're really taking technology to the next level, and which is also one of the focus areas of this budget. And setting up centers of excellence for artificial intelligence and getting industry players to partner in conducting, cutting edge research and applications. This is definitely what is the need of the hour. I think the other priority area also includes, infra and investment. We have seen quite a bit of investment coming into the infra sector, and the budget is, going to take a lead again for ramping up investment in the infra sector, assisting in getting more private investment, including in railways, urban infrastructure, and power. which has traditionally been, dependent on public resources. So that's also heartening to see. And along with infra, there is a lot of focus on green growth. When we talk about green growth, we are also talking about providing an outlay of almost 35,000 crores for priority capital investment towards energy transition. So that's again, something which the government is planning to do. As part of the other priority areas, I think there are two important aspects that were brought about. For efficient administration of justice, the e-courts project will be launched with, there's another phase of e-courts project which is going to be launched, and an outlay of 7,000 crore has been allocated to the e-courts project. This is heartening to see, given the amount of pendency, the amount of time taken for resolving disputes and the pendencies which exist currently at a courts level. Similarly, for settling contractual disputes, government undertakings where arbitral awards are under challenge, there a voluntary scheme is going to be introduced. So we'll have to see how all of those, play out in the near future. There is also quite a bit of focus on the financial sector and also use of technology, for participation in financial markets. The Gift City has been one of the government's pet projects. We are aware of that, but there has been quite a bit of, it's been a new project for the last 2-3 years, and a lot of administrative reforms as well as on the legal side were expected. So Radhika, do you want to talk about what one can expect on the Gift City front, where the regulators are concerned, and what the government is proposing to do?
Sure, absolutely. Thanks, Parul. So, as you rightly said, Gift City has been a bit of a pet project for the government, and over the past few years, they have been introducing a lot of regulatory and tax incentives to kind of grow and expand the International Financial Services Center at Gift City. One of the most critical pain points that stakeholders and investors were currently facing was essentially that because the IFSC is also located in a special economic zone, applications and ongoing compliances had to be made to both IFSCA as the IFSC regulator, as well as the Development Commissioner's Office as the SEZ regulator. This was a pain point across all sectors, but especially with respect to funds, because while with the introduction of the fund manager entity regulations, only fund managers had to register with IFSCA. On the SEZ side, both the fund manager and the fund itself had to kind of make two separate applications to the SEZ regulator. So there was, a total of 3 applications happening, a lot of redundancy. Both IFSCA and the Development Commissioner's Office would hold meetings with the applicants separately, asking a lot of the same questions. And, this just caused for a lot of delay and redundancy that was not really required, especially considering that the framework for the SEZ regulations was more to govern, manufacturing and goods industries, and not necessarily financial services. Which is why, it's been a very welcomed change that has been proposed in this year's budget, that the powers of the Development Commissioner or the SEZ regulator will vest now with IFSCA itself with respect to those units that are being set up in Gift City. That's all we know right now. But we do look forward to IFSCA providing some more information and kind of streamlining the process for these applications so that they go ahead and limit the redundancy and make it more specialized for the financial services industry. Similar to this, the government has also proposed creating a single clearance window for registration and approvals, where you'll have one online portal where you can file your applications for IFSCA, SEZ, GST, RBI, SEBI, IRDAI. All of that will be captured with one single online portal, which will also, go a long way in creating ease of doing business in Gift City, which is really what the main ask, I think, of stakeholders was this time around. In addition to that, the in this year's budget, they've also recognized offshore derivative instruments as valid contracts in GIFT City for the first time. So essentially, the Securities Contracts Regulation Act provided that contracts and derivatives could only be valid if they were traded on a recognized stock exchange or cleared on a recognized stock exchange, which made it impossible to actually have these offshore derivative instruments in GIFT City. However, now the SCRA has been amended to allow offshore derivative instruments to be issued by FPIs or Cat 1 FPIs located in GIFT City. This should obviously promote, especially the banking sector, and really it's a push towards onshoring the offshore ODI market, which is one of the objectives of GIFT City to begin with. The other kind of important change that also promotes banking sector in GIFT City has been the permission that branches of offshore banks in GIFT City now have to undertake acquisition financing. So domestically, the RBI has always been wary of allowing, or rather has restricted domestic banks from undertaking acquisition financing activities. However, now in GIFT City, the branches of foreign banks are permitted to do this, which of course puts them on par with other global markets. This is just another example of how the government is truly pushing to have GIFT City be a place within India that is on par with other global financial services centers. The last important change that I just wanted to briefly touch upon was essentially the government announcing that there are going to be amendments in the IFSCA Act to allow for the arbitration center to be set up in GIFT City and also deal with certain ancillary service provider issues that have been cropping up. This is particularly important because while the setup of the International Arbitration Center in GIFT City was announced a couple of years ago, we haven't really seen a lot of movement on that front. And I think by announcing that amendments are going to be made, the government is really indicating that there are steps that are being taken to get this launched and get this started, which will, of course, really boost the reputation and credibility of GIFT City as a global, as an IFSC. And secondly, on the ancillary services front, there is talks now that the government also wants to push GIFT City to be the global accounting and audit hub as well. So I think when we see some more changes on this front, we'll see them go towards providing more incentives for setting up certain accounting and auditing firms in GIFT City to promote that aspect as well. So,
Thanks, Radhika. Yeah, thanks a lot. I think that's quite a bit on GIFT City. Let's see how it fructifies. I'll move on to Ashish. Ashish, maybe you can take us through all the direct taxes changes which have come about, and just talk a little bit about what have been a few hits, misses, some opportunities lost, and some issues that may have been created.
Sure. Thanks, Parul. So I think in terms of direct taxes, we have seen a couple of important changes. The first one being with respect to tax rates, which is something that the people were really looking forward to. The second is the taxation of gaming, where they have tried to differentiate between online gaming and offline gaming. Now, this sector has been up and rising and is one of the sunrise sectors from the government's perspective. So I think some kind of regulation there was required, which the government has now come up with, which has also been a long-standing ask for from the industry. And we'll talk about that as we go forward. The other couple of changes are basically with respect to certain cost of acquisition changes on the intangibles. There is a tax on collected at source on the liberalized remittance scheme, which is being made by individuals. And Radhika already spoke about the GIFT City. So I'll quickly touch upon the tax rates, and then we'll take this forward with others talking about the other important changes that have come about. On the tax rates, I think the first one is that for entities and companies, the tax rate largely remains unchanged. With respect to individuals, the rebate that was available at 5 lakhs has now moved to 7 lakhs, which means anybody who's earning less than 7 lakhs can go under the rebate provisions, and there shall be no tax up to the amount of 7 lakhs. On the new tax regime for personal individual tax, which has now become the default regime. Of course, you have the option to choose choose about choose the old regime, but under the new regime, they have increased the tax exemption limit and reduced the number of brackets, thereby allowing some more liquidity in the hands of people. Largely, this is about the change. There is a surprising move by the government for high net worth individuals, wherein the surcharge for the highest tax bracket, which was more than 5 crore, which was above 37%, the surcharge was 37%, has now been reduced to 25%, thereby lowering the effective tax rate by approximately 3%, which goes down to approximately 39% for high net worth individuals earning more than INR 2 crores. I think on the tax rates, these are basically the changes. Why don't we move on to one of the important changes on REITs and InvITs, which was introduced as a specialized regime to foster investment into the India infrastructure and real estate. Now, tax incentives on tax has been one of the most important demands of this industry, and there is some change with respect to business trusts that the budget has brought about. Parul, do you want to take that and tell us a little bit more about it?
Yeah, sure. Thanks, Ashish. So when we look at, InvITs and REITs, now InvITs and REITs had been introduced in order to, bolster the infrastructure, at least for the InvITs. And there was a, in accordance with how REITs and InvITs work globally, there were a slew of tax incentives which were given, and low tax rates for income which is generated or received through these business trusts, being InvITs and REITs. Under the SEBI framework, an InvIT or a REIT is required to distribute at least 90% of distributable cash flows, and so is the SPV from which it derives the income. So when we look at the way that this industry was actually operating, there were three types of cash flows which were getting distributed. There was interest, there was dividend, rental income, of course, in case of a REIT, but there was also another category which was distribution by the SPV to the trust and then to the holders in the form of debt repayment or proceeds from amortization of debt. Now, this repayment of debt is not actually an expense, but it's more like, it's a repayment of on capital account, and hence it was not really taxed in the hands of either the REIT or the InvIT or the investor, and nor is it, taxed in the hands of the SPV. So what the budget really proposes is that, it tries to take care of this so-called double non-taxation issue. And now any distributions which are being made by the business trust to its unit holders will be regarded to be taxable income in the hands of the unit holder. This is a kind of a loophole which was being utilized by many of these, business trusts in order to make distributions which did not fall within, dividend interest. Anyway, for dividend, one needs profitability at the SPV level to distribute dividend. Interest also, there is a coupon within which the interest can be distributed. But repayment of debt was a good way of making distribution of excess cash flows which were available at the SPV level. Now, actually, what happens is that this gets distributed to the unit holder and then it gets taxed. However, unfortunately, there is no low rate of tax which is available for the unit holder in comparison to, to dividend or interest taxation, where there is a favorable tax regime for receipt of dividend or interest income from a business trust. So hence, what will happen when we talk about a non-resident investor? This income will get subject to tax in the hands of the non-resident investor at the rate of 40%. And, it really depends if the investor is coming from a treaty jurisdiction, what the terms of the treaty really talk about, and whether one will be able to claim exemption under the provisions of the tax treaty. Another, point which is of concern is more with respect to sovereign wealth funds and pension funds. Now, currently, SWS and pension funds do have tax exemption if they're investing in the infra sector, but that's primarily for income in the nature of dividend interest or long-term capital gains, which they're earning from their investment in the InvITs. Now, with this amendment, which has been introduced because the repayment of debt does not get classified as dividend interest or capital gain income, they will be unable to take, a sovereign wealth fund exemption for such type of distributions which are being made by the InvIT to the sovereign wealth fund. And there is quite a bit of, an allocation that happens with respect to distribution in the form of repayment of debt. So probably InvITs will have to rethink on their entire distribution policy. Another aspect is that when these distributions are made, there are two ways in which the distribution could be made. The distribution could be just as simple as the distribution on the units. It may also be possible that units held by the unit holder may be redeemed. Now the budget proposes to also tap into the redemption of the units. And ordinarily, if a unit is redeemed, that could be classified as a capital gains tax event. But in this case, since redemption of units is also now supposed to be captured under, under this change and hence classified as income from other sources, there seems to be a shift from characterization of income from capital gain to income from other sources. And again, this would mean that foreign investors may not really be able to take exemption under any tax treaty. For example, the Singapore tax treaty still provides for an exemption for redemption of units of a business trust. So, clearly on the REIT and the InvIT side, while the government has tried to plug a loophole, but what would have been a welcome change, if at least the so-called loophole would have been plugged with at least providing some concessionary rate of tax as exists in the case of dividend or interest income. So over to you, Ashish. I think this is a very important change which has been brought about. Also considering the government's focus on infra sector, this will mean a lot of business trusts will have to rethink on their distribution policy.
Sure. Thanks, Parul. Considering we need to incentivize this structure, I don't know how such an amendment is going to be helpful, but we'll see as we move forward. I think my next question is to Gauri. I think Gauri, on the online gaming, there has been a lot of discussion talk with the government in the last couple of years, and finally this year's budget has made some amendments. Can you please let us know about the amendments and your thoughts on that?
Sure. So I think the talks were on two fronts. One is the TDS, the other one is GST. The latter one being more sort of burning issue. But I think that nothing we saw on the GST side for this industry. So I think let me just take a step back and sort of also explain what are the relevant things that are happening. So we have, the ABCG task force report that was published. Then we have the central government coming out with the draft rules for the online gaming industry, which basically all these initiatives demonstrate government support for the industry. Now, insofar as the provisions from a direct tax perspective are concerned, so we earlier had a provision, as those familiar with the industry will know, that we earlier had a provision on TDS for any winnings from the gaming, activity, to be deducted at the time of payment. Now, there was a lot of gray areas in terms of how you compute, winnings, or how you may, at what point in time, that the payment should be made, etc. What the government has now done, they have created a specific provision for online gaming. Now, online gaming, they have not distinguished what, or rather not defined what all will get included in the word online gaming. The definition is quite wide. To give an example, in India, the skill gaming is generally understood to be a kosher activity, but the it's not only but the games of chance are somewhere considered as prohibited activity, but the definition is inclusive of both. They don't distinguish between skill game or chance game. The other one is, we have seen a lot of esport activity coming up also, right, over a period of time. Now, there may be some tournaments where I join a tournament and I win something out of that tournament, right? So the wording is too broad. One can sort of take the benefit to say that, any and all sort of games get included. So that is my point number one. Point number two, the clause appears, or the section appears to be applicable not only for the Indian operators but offshore operators as well. Now, Indian government has taken a strict stance insofar as availability of offshore gaming websites in India, especially the sports book and the the casino type of games. And there have been some prohibition that were sort of issued from the so that the access to such websites are not available. Having said that, if the question arises that even if the access continues to be available for some websites, then whether these provisions get triggered, and it appears on the face of it that this provision may get triggered in that case as well. The next point is, what amount are we sort of deducting the TDS, and what rate? So 30% is the rate. But interestingly, the earlier provision which I said, the trigger was after 10,000 rupees of winning, right? Only when you hit that amount. And how to compute that amount was always a question mark. Is it a daily limit, a monthly limit, an annual limit? Those questions were there. But now this particular provision doesn't discuss anything. They say any withdrawals at the time of withdrawal, that 30% will apply through the financial year. And if there are not been any withdrawals, then at the end of the financial year, you are going to the amount that is in the net winning account, that is where the tax will be charged on that amount. Now the question is, what is net winnings? That is the key question that has not been answered. That is what the rules will prescribe. Prima facie, it should be so suppose I'm staking or I'm putting in, say, 10 rupee on the table and I'm winning 20 rupee. Typically the net winnings even internationally should be the 10 rupee, right? 20 minus 10. So that should be my net winning, and the amount, the tax should be on that amount. But I hope that is what they do, overall. But my point is, in the Indian context, a lot of these gamers honestly are doing very micro transactions. We have seen that Indian economy has been a micro transaction economy, right? So when you have multiple micro transactions where people may be spending, and I was talking to some members, also, that maybe 300-400 rupees a month, right? So imagine the winnings also, consequentially, what could be the amounts of the winnings? Maybe one person may, sort of hit, maybe something in thousands or lakhs. But generally, it is a micro economy thing. And these will be the people, quite a few people will not be in your general tax net, right? Because of the thresholds that we have, the basic exemptions, etc. So what they have done is, in my view, slightly regressive, because earlier you did have a limit on 10,000. Now you don't, right? Ideally they should have pushed some thresholds after which the tax starts getting deducted, which they have not done, unfortunately. So we need to wait and watch. And of course, because of this change, all the gaming operators will have to reset their software as to, from a computational perspective, right? And they'll have to sort of redo their processes, and also when the inquiries or some investigations happen, luckily, all these all are digital recorded transactions. So from a, if there is any audit or something, it's quite easy to demonstrate their entire flow of funds. So that should not be a problem, that the industry in any case does. But they'll have to shift their software to do these computations in the manner that is contemplated. I hope the rules come out very quickly to clarify these positions, so that the operators can have a clearer idea going forward.
Thanks, Gauri. I think that's a helpful understanding of the gaming provisions. And I think that, putting out a net winnings and tax on withdrawals is a positive move. But not having a threshold for TDS is something that was not foreseen. Anyway, we'll move on to the next topic, which is the exemption on, which is the Section 56 issue. Now, I think Section 56 is almost becoming a saga, right? Where we had Section 56, which said that if you are receiving, if the company is receiving any money more than the fair market value as determined under the rules from a resident Indian, then the company would be subject to tax on the difference between what is the fair market value and the actual money that is received by the company. Now, this provision was effectively only for residents, wherein if the residents were investing more than the fair market value. There has been a lot of debate on this provision with respect to startups, where startups were finally given an exemption if they were a registered startup, if they had a paid up capital of a certain amount. Non-residents were always excluded from the ambit of Section 5627B, including AIFs, which were of Cat 1 and Cat 2 nature. But the budget makes a significant amendment to this section, and says that now even non-residents will come within the ambit, which means that if a non-resident is now investing more than the fair market value as determined under the rules, then the difference between the investment amount and the fair market value would be subject to tax in the hands of the company as income from other sources. Now, from a PE perspective, from a PE-VC perspective, this has a significant impact. To uh, to explain how this would work and what is going to be the real impact, we need to understand that the FMV determination is based on a DCF value basis the formula that has been provided. Now, there is a gap between how a founder perceives the valuation and how the investors perceive the valuation of a company. Now, to bridge this gap, the investor often invests at a price higher than the FMV, but it has some rights such as the anti-dilution rights and liquidation preferences, etc. Now, if this provision is going to also be applicable to non-residents investing money into an Indian company higher than the FMV, then it is going to have significant issues from a negotiation of such rights perspective, and for fundraising by the Indian companies. And to put it, differently, this is going to definitely make investing into India by private equities less attractive because of this provision being now applicable when money is being taken from non-residents as well. I think, Partha, there was a question that you had on this issue. So I think that I have answered also. Coming to the next point, which is basically for Afan, which is on the startups which have been given a number of incentives over the past couple of years. So Afan, do you want to take us through the changes that have been proposed by this budget for startups?
Sure. Thank you, Ashish. And before I begin, I just wanted to take a minute to echo, what Parul and Nishith bhai said about the budget in terms of it's interesting to see how they focused both on aspects of economic growth by providing some changes both on the demand side as well as the supply side. And at the same time, they've also focused on, ensuring and bringing about economic stability by focusing on certain environmental and social factors and digitization and things like that. So it's interesting, and it is hoped that there will be effective implementation of some of the key reforms that they've spoken of, so that the economic growth number or the fiscal deficit number that they have estimated really comes to fruition. Now, in that context, touching upon what is there in store for startups. Now, of course, they have made some few tweaks in terms of, rationalizing the provisions. So, uh, a year ago or 2 years ago, there was a change that was introduced with respect to startups. So, usually, Section 79 provides a restriction on carry forward of losses when there is a change in shareholding. And the condition is that at least 51% of the beneficial owners of a company should continue to be the same between the year in which the losses were incurred and the year in which those losses need to be set off, right? But an exemption was provided to startups where this 51% beneficial ownership requirement was done away with, and they said that if, let's say, even 100% of economic ownership continues to remain the same, even if the beneficial ownership of 51% is not satisfied, even then startups would be able to carry forward and set off the losses. Now, along with this, there was an additional condition that was introduced, which is that those losses had to be incurred within a period of 7 years since incorporation. In this budget, they have made this one additional change where they have said that instead of 7 years, those losses could be incurred for the period of first 10 years since incorporation for them to be able to be set off, carried forward and set off. And another small change that they brought about is that if in the budget is that uh, earlier for startups to get the 80 IAC benefit, which is 100% tax deduction for 3 consecutive assessment years out of 10 years, were only available. It had a sunset period, and it was available for startups incorporated until April 1st, 2023. They've extended that to startups incorporated up to April 1st, 2024. So while there are some important tweaks that they've made, and that will go a long way in helping startups, but some of the expectations that the industry had, especially in terms of what came out in the economic survey, does not seem to have really been implemented or sought for in the budget. So, for example, some of the expectations were that there will be parity of LTCG, long-term capital gains of sale of shares of startups with sale of shares of listed shares. But nothing like that has really come about. A few years ago, the option of deferred payment of tax on, ESOP, on exercise of ESOP when it's taxable as perquisites was introduced. But it was only introduced with respect to eligible startups. It was hoped that, it would perhaps be introduced for non-eligible startups also that do not have a certificate from the ministry. But nothing of that sort has come about. And another thing that was spoken about in the economic survey, of course, was internalization, with India becoming a global hub for business. There have been a lot of talks about how instead of companies globalizing, a lot of companies are now wanting to move back or move their headquarters back to India. And such movement back to India and such redomiciliation back into India is likely to incur a lot of tax costs for those MNCs, and it was hoped that maybe some incentives would be introduced in the budget, but nothing has come about so far. And lastly, of course, despite all of the tax benefits that have been provided for startups, one of the sticking issues that has always been there is really the definition of eligible startups and the number of conditions that need to be satisfied for them to even qualify as startups. So it is hoped that in the coming years or in the future years, there is some reform there, such that more and more startups are able to take those benefits. Over to you, Ashish.
Sure. Thanks, Afan. Uh, I think we'll move to the next point. Uh, Parul, I think there has been a change on the tax collected at source for people who want to make remittances abroad under the liberalized remittance scheme. Can you tell us about this change and also the impact that this is going to have?
Yeah, sure. I think this is a really big one. Probably an uncalled change. There was already a 5% TCS, which is tax collected at source. At the time, remittances were being under the liberalized remittance scheme. Now, what really is being done is that under the liberalized remittance scheme, any payment which is being made for education, medical purposes, the TCS rate on that remains to be 5%. But for anything else, the TCS rate actually goes up to 20%. So this covers investments being made abroad. This covers any gifts which are being made, abroad. A lot of people have their children studying abroad or family abroad. Uh, the TCS rate of 20% is pretty high and unwarranted. Earlier, the whole idea of TCS was to track transactions, and the 5% rate was doing the tracking of the transactions as such. But now with the 20% tax rate, this will result in a cash flow issue. So consider an investor who wants to make an investment in stock outside India. There is going to be an additional 20% which the Indian investor will have to shell out. We recently saw changes to the overseas investment rules, which have anyway made it pretty challenging for Indian individual residents to remit money under the LRS route, and a lot of flexibility abroad, for investment abroad has anyway been hampered. Now with this 20% TCS rate, this will have another impact on investments being made outside India. Of course, the TCS which is collected can be adjusted against advance tax. It can be adjusted against other taxes which the remitter needs to pay in India. But nonetheless, it presumes that the taxpayer, because he's making investments outside India, is a high net worth individual. That presumption by itself seems to be a little bit off the track. And in many cases, it may be possible that people may then have to claim a refund, which will again go into the refund machinery of the government and, again, create a lot of issues. So this is something clearly which was totally unwarranted.
Sure, Parul. Thank you. Uh, I think we are almost out of time, so maybe we'll extend for about 15 minutes because we'll cover some of the other provisions also that have been amended. And to that, I'll take to Gauri to ask her about, what is the change for intangibles with respect to cost of acquisition in the budget.
Sure. So I think, in my view, this was slightly a surprise move, and I don't understand why this was done, because the budget speech also doesn't give much for us to fathom. So just on a quick note, when we talk about capital gains, right, you need to compute what is the amount on which the tax will be levied. So in case of capital assets, it's the full value of consideration minus certain deductions. So those deductions are such as cost of acquisition, cost of improvement. So, Section 55, which essentially sort of gave some deeming provisions for cost of improvement, especially for the homegrown assets. So, just to give an example, when we say a goodwill, right, or a trademark, this you generate, you're not acquiring from some third party. When that happens, when it is self-generated, the cost of acquisition is considered as nil. Because then what happens is, if your sale price is say $100, the cost of acquisition is nil, then the amount of capital gain is 100, on which the entire capital gains tax will apply. Now, earlier, there were certain assets which were identified for which such a deeming provision of nil acquisition cost and improvement cost was applicable. For example, goodwill, trademark, right? These were the ones, or right to manufacture, produce, or process any article or thing, right? When you acquire that right. But now what they have done is they have extended to any other intangible asset. Now, all the immovables, when we say intangible, typically all the immovables will get included. Now, earlier, especially this will have an impact on software industry. So just want to lay it out there, because the copyright was not included in this list, right? So therefore, earlier, if the software industry had homegrown IP, right, which in India you will imagine there will be a lot of that, and when the sale used to happen for that, this deeming provision would not applicable of nil acquisition cost. So in my view, at least for the software industry, I know we are running out of time, this will have an impact. And as I said, I'm not very sure why this change has been made. I don't see any sort of discussion around that before this change has been made.
Sure. Thanks, Gauri. Afan, I think my next question is to you with respect to the changes for ease of doing business in India from a litigation perspective. Do you want to talk about those changes?
Sure. I'll try to keep it crisp, but of course, a lot, tax litigation landscape is an important indicator of ease of doing business in India, much like other litigation landscapes also, but tax litigation in particular. And of course, a lot can be hoped to further streamline and make the process of tax litigation more seamless for businesses in India. But we do have to, commend the government for its job over the past few years and its continuing process in trying to bring about some good reforms in the tax litigation landscape. We've seen in the recent past things like overhaul of the entire reassessment proceedings, introduction of things like faceless assessment and Vivad se Vishwas scheme to do away with massive litigation. In similar light, some changes that have been introduced this year are helpful. One of the most important changes is that having realized that there is a lot of overcrowding and burdening happening at the commissioner appeals level, which is resulting in the clogging of these litigation matters. One of the important things that they've come out with is to come up with a coordinate institution to the commissioner of appeals, which is of the joint commissioner. So now they have identified a list of matters or a list of scenarios in which the appeals may go to this coordinate institution of joint commissioner instead of the commissioner of appeals, with the hope that the matters are spread across and there is faster and more effective resolution of justice in that sense. Other than that, even with respect to the appellate tribunal, they have plugged some of the leaks. So Section 253, which provides for appeals to the appellate tribunals, lays down the specific types of orders against which appeals may be made. Now, certain types of orders which are passed by commissioner appeals, like for example, orders that deal with certain penalty provisions, or certain orders, that deal with revision or rectification. Appeals against those orders passed by the CIT were not available. Now they have plugged the leak by adding some of these provisions in 253, such that appeals against these orders will also now be available at the ITAT level. Other than that, in terms of TP proceedings, they've brought about a small change. Of course, this is favorable for the revenue, and where basically under Section 92CD there is a requirement of any person entering into any international transaction to maintain certain TP documentation, and when called for, if a notice is served on them, to furnish them. Now, the timeline to furnishing the minimum timeline for furnishing such information in the current regime is 30 days, which can be further extended to another 30 days. Now, realizing that this minimum period of 30 days was becoming a long period of time, and was sort of also making it difficult for tax officers to conduct proceedings in light of limitation periods, they have and also bearing in mind that this type of information by law is anyway required to be maintained by the assessee, they've brought down the period of furnishing this information to a minimum of 10 days, which may be extended finally to a maximum of 30 days. And other than that, I think one other change which actually might be looked at favorably by some of our foreign businesses, especially, is in terms of the time limit for completion of assessment. This is a small point, but might be significant, which is the time limit under 153 currently as it exists is to complete assessment is period of 9 months from the end of the relevant AY. So if the AY gets over on the 31st March of any particular year, then the time limit to complete it is by the 31st of December of that year. Now, in that context, it should be noted that if that Section 143(2) notice may be issued within a period of 3 months, or can be issued within a period of 3 months from the end of the relevant AY. Now, what that does is that it effectively then provides only a period of 6 months for the assessing officer to conduct the assessment, and that includes a lot of things, right? Conducting investigations, giving an opportunity of being heard to the tax officers, collecting information, so on and so forth. So 6 months was turning out to be not an ample period of time, and it was actually compromising on the principles of natural justice, because even the taxpayers were not being able to effectively respond to these notices. These concerns were highlighted, and what this budget has taken into account, and they have actually changed that period of 9 months to 12 months. So now the period of limitation will end in the March of the following year and not the December 31st of the same year. And of course, it's good news for tax practitioners, and also for foreign clients, that they will not be harassed by tax notices towards the end of the year during Christmas and New Year holidays. So those were some of the few changes on the tax litigation landscape. Ashish, over to you to sort of take us through other reforms and close the loop.
Sure. Thanks, Afan. That's helpful to note that the government is doing so much for ease of doing business in India with respect to litigation. Uh, I think I think this is end for me with respect to the questions that I have for everybody. Nishith bhai, I think you would you like to talk about something more or give some closing comments?
I think you all had an excellent conversation, so very little to add. But I think the fundamental question arises is that the way in which we present budget, is this a right way to do it? Because we pronounce budget on 1st of February, and then very quickly budget gets passed. There is not enough time for people to interact, people to, at one point of time, historically, we used to have law commission, especially for substantive changes, so that the whole language of the law was well looked into. Also, all consequences, including constitutional validity of some of the provisions, were looked into. So that practice has been given go by. So if we can have some revisitation of the process in which the budget is present. No longer secrecy is needed. Everybody knows that, At one point of time, it was secret, and most of our indirect taxes that was relevant, but now that also has changed. So it's important that we revisit the process. And for example, in the US, uh, any change to be done in tax laws, you know, requires some kind of estimation of revenue or consequence for 10 years. Now, here what happens, sometimes the judgment comes from a court or otherwise, and if tax department doesn't like, then you change the law, go back and forth, and so it's slightly reactionary. It would be useful to have comprehensive look at the whole tax law. Number two, that lot of learnings have happened, principles of interpretations have changed, principles of application of law has changed. So I think there are a lot of learnings that we can do from whatever experience we have. While there are good points in the budget, but at the same time, the whole process we need to revisit, and we go back and forth, go back and forth. It was mentioned that LRS scheme, for example, it's just over $250,000, right? What's so big about it? Actually, we should have moved to capital account convertibility by this time, because that was the whole intention in 1991 when we moved to trade account convertibility. 1999, we went to current account convertibility, and the proposition was that we should be moving towards capital account convertibility. Now, after 1999, about, it's how many years now? 20, 25 years. And we can't move an inch. On the contrary, we are going back. So some of these things, I think, needs some rethink. That is what will improve ease of business. Today, no doubt, India offers great opportunities. So people will come, but I think we need to accelerate the process. And ease of doing business is very, very critical, which everybody talks about. Even startup ecosystem, how many changes we go back and forth, and you already mentioned some issues that coming up, So what happens, even though we do good, it doesn't come out to be good. And at the same time, people say, oh, it's too messy. When we talk to the global board of multinational companies, you got 2-3 minutes to talk about India, within which they say India is too complicated. Okay. So sometimes, some of this situation, we want to make sure that perception of doing business in India is also well communicated and well implemented. So that is what is my main comment. I also feel that time has come to completely revisit capital gains regime to explain capital gains and its taxation to a foreign investor or foreign entity which brings large amount of investment is very complicated. If you can revisit the definition of capital gains, even for example, accrual in relation to earned income, earnouts, for example, the issues of inflation indexations to so whole definition, short term, long term, this kind of security, that kind of security, real estate is different and all that. So let us streamline the whole process. That will make it look, the whole country better. While we are good at it, but at the same time, we need to look better today. And that is what would be my broad comment, that we should give more time. Let us start working for the next year's budget from now on. Okay, ease out all the wrinkles that we see for doing business in India, and let's make a better world. And now lot more new issues are coming up. In fact, transfer pricing has become a subject matter of conversation at board meetings and stuff like that. So ESG is getting more prominence. So there are a lot of issues that are going to come. And finally, one point I would make is that we all need to understand how a business is carried out. Gauri mentioned about micro level issues on gaming. Okay. If you do not understand the business, your law will be out of sync. Instead of encouraging activity, you may discourage, or you may, intended benefit is not percolated. If you look at international tax, about 70 to 80% of issues today relate to intangibles. Okay, but very little understanding of that. Okay, and And so we need to understand how this interplay happens, how other laws are operating with vis-a-vis India. And I don't want to again stretch the discussion too long, but my macro level comments were, the ones that remain. So let's make it more easy and start from today for the next year. We have great time to go, and by definition, we have enormous amount of opportunities in the country. It is just that how do we make it happen? Not just happen, but happen at the speed of thought. I think the speed is of the essence, and if you can do something together, wonderful. All of you are welcome to give your comments, and we'll be happy to take up with the government or other agencies and facilitate our conversation. Thank you so much.
Thanks a lot, Nishith Bhai. And as someone has put in the chat box, Nishith Bhai is echoing the real voice of a forward-looking citizen. So thanks a lot with those great closing remarks, and thanks, for our, for all the people who've joined us today to listen to us. Please feel free to reach out to us, if you have any questions. We try to answer most of the questions, through the chat box, but, feel free to reach out to us. We are an open source organization and believe in disseminating as much knowledge and information as we can. So thanks again, everyone, and have a good day. Thank you.
Thank you.